let's be straightforward here. Tariffs are taxes, and taxes suck. I don't want to be liberated by taxes. I want to be liberated from taxes. The idea that he imposes a tax on Chinese merchandise or Canadian merchandise or Mexican merchandise, and the Chinese or the Canadians or the Mexicans pay the bill, is laughable. It's about that wall. It's like that wall he was going to build with Mexico's money. Now, I don't want people to think that, as an example, I preferred Biden to Trump. I have no use for either of them. I prefer Gary. Okay. But people need to understand that behind the nationalistic, jingoistic nature of these things, tariffs are taxes. Taxes are bad. Division of labor, internationalism, responsible internationalism, truly free trade, not managed trade, is good. And when I talk about free trade, I'm not talking about NAFTA. These tariffs are in the same spirit that NAFTA was in. It's a framework for punishing the administration's enemies and helping the administration's friends. Remember that politics, whether Democrat or Republican, are, in the words of H.L. Mencken, always and everywhere advanced auctions of stolen property. That's the nature of it. You know, I'm not a gloom and doomer. We're going to come out of this over time, okay. But the truth is that, first of all, the systematic management of interest rates lower, artificially low interest rates. For an old fat guy like me, they're a great thing. If you have access to credit, subsidized credit is good for you. But if you're a saver, it's bad for you. An old fat guy like me who has access to credit and knowledge of how to use it, subsidized credit is a wonderful thing. But it's a horrible, horrible, horrible thing for society. And the misreporting that you describe is, I think, worse than even you realize. At its most simplistic lesson, the CPI should be called the CPI.
Right.
If you believe the CPI, it suggests that the deterioration of your purchasing power is cruising along at 2.6%. What a joke. Compile a list of goods and services that you consume, look at their prices in 2020, and look at their prices now. Rent or mortgage payments, gasoline, groceries, healthcare, health insurance. I believe that the deterioration of the purchasing power of American savings and salaries is declining at between 7.5% and 8% a year, not 2.6. The single scariest thing to me, Gary, and by the way, I'm not forecasting a sort of a 2008 style event, but the black swan that really scares me is junk corporate debt and the fondness for fairly naive ma and pa investors in the United States to chase yield. In particular, there are trillions of dollars of high-yield ETFs, which are extremely liquid at the ETF level. Hundreds of millions of dollars of these things trade every day on the stock exchange. But the assets that they own, the junk bonds, the over-the-counter bonds that make up the portfolios of these ETFs are highly illiquid. If ma's and pa's across America get concerned about credit quality, and I think they should be concerned about credit quality, and they begin to sell the ETFs, which are highly liquid, the manager has to sell the underlying assets, which are illiquid, to fund the liquidations. In the 1970s, Gary, we had a saying around junk bonds, illiquid junk bonds. We called them owl bonds. An owl bond is when you call your broker and say, sell the bond. Your broker says, to-hoo, to-hoo. If there's one thing out there that scares me more than anything else, with the exception of nuclear war, it is the proliferation of junk bond ETFs and the ownership of those ETFs by naive investors who know absolutely nothing about the asset class that they're invested in. While it's true that the United States has some resources, the resources that we have in terms of tonnage and grade are not competitive on a global scale with resources that exist in other countries. So in addition to having to subsidize the U.S. supply chain, we have to secure access to foreign supply. This will take a long time. There's little competitors against us. People like Korea, Japan, China, the European Union. We don't act in a vacuum. The second thing is, should the industry want Mr. Trump's help? The truth is, as a natural resource investor for 3 decades or 4 decades, I've been reviled, hated. 5 years ago, people like me who were investors in uranium were regarded as profiteers on Hiroshima and Nagasaki and 3 Mile Island. Now these morons propose to subsidize us. I felt much cleaner when I was reviled. I would prefer that the administration merely got out of my way. The second question is, assuming that you have a way clear at the top, which is to say Mr. Trump, he has a deal with state and local regulations. Remember that regulation in the United States is tripart. And I'll give you one example of that problem. One of the best undeveloped copper deposits in the world is the Resolution deposit in central Arizona. Beautifully located amongst a whole bunch of copper mines. It's a great place to have a copper mine. There's roads, there's rail, there's power, there's water, there's towns with gas stations and 7-Elevens, and those towns are populated with copper miners. Couldn't get better than this. Deposits over 1 million tons of 1.5% copper. To put that in reference, the global average mine grade worldwide is 0.5%, and this is 1.5%. And this deposit has been stuck in permitting for 26 years. So you ask how long it might take. I'm 72 years of age. Most of my remaining lifetime is the answer. And by the way, I'm a very healthy 72-year-old. And my suspicion is that you will see increasing capital investment in all aspects of natural resources. I suspect for most of your listeners in the near term, gold is a better place to be. But over the next 5 years, this systemic underinvestment in the materials that are required for the continued material well-being of humankind will do very well. We've underinvested even in the big ones like copper for 30 years. Yeah. We have impending supply shortages no matter what we do. In other materials, the ignored materials, as an example, rare earths, which aren't rare, the potential bottlenecks are much, much, much worse. I think it's incumbent on your listeners, most of whom are probably American, that they think about this context on a global basis, that they forget a little bit of their political bias, and that they look for the best deposits on the globe. Because your biggest risks aren't political, those are risks. Your biggest risks are technical. A lousy deposit remains a lousy deposit, whether or not you have a favorable administration next to it. A good deposit remains a good deposit. It is better, you are better off having a deposit that a government wants to steal than having a deposit that's not worth stealing. We're in the M&A cycle right now. There isn't a month that goes by that I don't get a call from a major or intermediate gold mining company saying, who should I be looking at? What opportunity should I be entertaining? Some of them will admit to me that their exploration pipeline is empty. That when they call the exploration staff, they're reminded by the financial staff that they laid the explorers off 15 years ago and don't have a department to call. So the circumstance that you're talking about isn't a circumstance for the future, it's a circumstance for the present.
That's wonderful.
We are in the M&A cycle. The recent, by the way, we're in 2 different types or 3 different types of M&A cycle. The first is that the share price performance of the best of the gold miners, the biggest and the best, in the last 12 months have been really, truly superb.
Yes.
But there's been a dichotomy. The best of the best have done well and the rest have not done well at all. That means that the Agnico Eagles, people like that, have a very low cost of capital because they have a high share price. And they're in a world where their competitors have a high cost of capital. Capital cost is a durable competitive advantage. If the equities market doesn't begin to do valuation arbitrage, which is to say come down the quality trail, the M&A market will. The low-cost producers will take over the high-cost producers. Similar, I mean, look at the takeover of Newcrest by Newmont. That's a classic example of high cost of capital being acquired by low cost of capital. The second thing that's happening is that single asset producers are regarded as riskier than multiple asset producers. So multiple asset producers trade at a higher multiple. The way you fix that is a multiple asset producer takes over a single asset producer, and then arbitrage goes away. And then, of course, there are horizontal mergers. In today's environment, the larger companies have more trading liquidity, higher share prices, and they get more passive and index buying. So recent mergers, like the Equinox-Calibre merger, the proposed Equinox-Calibre merger, are, while not particularly synergistic, certainly ones where we could expect the trading volume, the share price, and the cost of capital to fall as a consequence of the merger. We're in a wonderful circumstance. Mergers add hope and liquidity to the sector if you happen to own the company that's been taken over. But early in the M&A cycle, the mergers are often accretive to the acquirer too. Whatever happens, properly structured mergers lower the cost of capital, spread general and administrative expense over larger asset bases, and give management teams, the new management teams, the ability to make asset allocation decisions across broader asset bases. The question you ask is a great one, and it's an important theme for precious metal and natural resource investors to consider. It's a ringing bell. I'm not trying to say that mining companies are great investors, but they're the best investors out there. And if they see that they can acquire assets on Bay Street or Wall Street more cheaply than they can explore and develop them themselves, they are sending a signal to institutional investors who are by their very nature less expert